Hello everyone, I've recorded this part of the lecture where I'm trying to answer some of the questions that you gave me in class last week. Thank you very much for posing those questions. I've taken some of them and tried to answer them as best I can. The first question that I'm taking is, what is important to focus on in a financial analysis class? And I've taken that question first because I think it's very fundamental, gets to the heart of what we've been talking about over the last few weeks of how do we focus when we're talking about financial analysis. And the answer is it really depends on what we're trying to show. If we're trying to analyse the operational efficiency of a business, then we might focus on things like how quickly we turn over our inventory or how successful our staff are at generating revenue. We might calculate a ratio such as revenue per employee that we saw in Lufthansa. If we're looking at focusing on shareholders' perspectives, so if we're looking at what sort of return the business generates for shareholders, then we might look at ratios such as profit margins. We might also look at some ratios which include the market value of shares, such as earnings yield, where we compare the profits of a business to the price of the share. So we look at how much it would cost us to buy a share today and what profits the business would generate, so it gives us a kind of return on investment. If we're looking at this from the point of view of a bank who might be approving a loan or otherwise, then we'd probably be less concerned about profits because the bank won't get the benefits of any increase in profits. The bank really just cares whether or not the business can service its debt. So we look at the ability of the business to service the debt. We might look at something like interest cover, or we might look at gearing to make sure the business isn't too highly indebted, that it wouldn't be too high a risk for the bank to take on. So I've got a couple of questions on how much we can rely on the information in financial statements. One question, how do we know the level of truth in financial statements? Well, you may remember in week 1 we talked about regulation. We talked about the relationship between directors and shareholders, and we said that regulation intervenes in that relationship so that shareholders can be more confident about the financial information which directors are producing. So we mentioned national legislation as a source of regulation. We mentioned stock exchange regulations and, of course, financial reporting standards, that process of standardizing the information in financial statements so that two different people looking at the same set of transactions would agree on how those transactions should be represented in the financial statements. Of course, financial statements are also audited. Independent outsiders, auditors, review the financial statements and review the underlying documentation supporting those financial statements, and they give their professional opinion on whether financial statements provide a true representation of what happens in reality. Follow-up similar question, the data could be manipulated. How certain can we be when doing financial analysis? And the question linked to that, what is creative accounting? So creative accounting is when we start to manipulate the data, when we try to present information to give a particularly overly optimistic or overly pessimistic viewpoint. And we're going to talk a little bit about creative accounting in next week's meeting. I'm going to show you some examples of creative accounting. And yes, we need to be alert to the risk that the accountant that's prepared the financial statements has not given us a neutral representation of reality, but that they are manipulating the information in some way, either because they want to present the business in a good light, to try to keep the share price high, to try to get additional investment in the business, or in the worst case scenario, because they're engaging in deliberate fraud. Those cases are actually quite rare, but they do exist. Next question, are there different types of financial analysis? Yes, there are. We've done a generalized approach to financial analysis where we've looked at the information in the financial statements, and sometimes we've looked at return, sometimes we looked at risk. We've mentioned that we can look at financial information from different perspectives, such as shareholders, lenders. But yes, depending on the perspective you're looking at, you might focus on a different sort of financial analysis. We have actually been looking at financial statements for the most part, but another type of financial analysis takes place within the company when the managers within the company analyze projections of future cash flows, for example, to decide whether or not an investment is worthwhile. I believe you've got an elective on investment appraisal as well. So some of you may have looked in detail at investment appraisal. That is another sort of financial analysis in the sense that we are analysing the information available in order to come to a conclusion about what our next course of action should be. Also, if you look at the extract from the textbook that I've put onto Studip, the Attrell and McClaney textbook, you'll see a discussion there about different sorts of financial analysis, different sorts of calculations we can do. Next question, what factors or indicators in financial statements does a company need to consider before taking out a loan? That's a good question. Well, a company needs to consider whether or not it can afford to pay back the loan. So it will be looking at things like the interest rate on the loan as well as the amount it's borrowing, and it wants to be confident it can service that debt. It also wants to be confident it can service that debt and still have some profits left over to distribute to its shareholders or to reinvest in the business. So interest rate is a big thing to look at, as well as the measures of gearing, for example, that we've been looking at, because that gives the company information on how well it can support a new loan. Next question, this is a really interesting question. How many people are usually involved in preparing financial statements, especially for very large companies? That's a good question. There could be hundreds of people involved in preparing financial statements for a large multinational PLC. You could be looking at a team of hundreds of people because each subsidiary company within that group will also be preparing its own company accounts. Those company accounts will all be put together at head office in order to prepare the group accounts. Typically, one person has overall responsibility for signing off the financial statements, and that will be the director. But underneath the financial director, there will be a team of tens, if not hundreds of people that are working on different aspects of the financial statements. And last question, how reliable is financial analysis in real life cases? Well, financial analysis can give us a lot of information. No analytical approach is completely reliable. We can never be completely confident either that we've done a full analysis or that the figures that we're looking at are totally reliable. But by calculating a range of ratios, we are effectively triangulating between different positions. We're not relying just on one calculation or on one particular performance measure. We're looking at a range of performance measures, and that allows us to build up an overall picture of the business, and that means that we can have more confidence in our analysis.